Let's briefly recap what we know so far. We studied the different types of charts, the bar chart, the line chart, candlestick, point and figure. We've studied the psychology behind supports and resistances, the three types of trends, bullish, bearish, and sideways, classification of these trends, long-term, intermediate, and immediate trend. We looked at the concepts behind drawing trend lines, the relative steepness of these lines, and we've also looked at price gaps. Once traders identify trends, channels, supports, resistances, many times in trading it so happens that we wish to enter the market, we have a good view, but we see that a trend is already in effect and prices have moved much higher than where we expected to enter the markets. In such cases, it's very common to get frustrated with ourselves for missing the price run despite having the right view. Other times, if the trend has paused, we are unsure whether the trend will continue or we will see further dips where we can buy, or we might see even a reversal of the existing trend. If we buy too high and the market starts to correct, our margins might get wiped out or we may lose our nerves. Timing the market is one of the key skills traders need to develop. Traders therefore look at pauses in the market, a period of consolidation or retracements when they can initiate positions or add on to their existing positions. Prices in these periods tend to form patterns during the overbought or oversold conditions. Now these patterns are called consolidation phases. So in the overbought and oversold conditions, the longs and the shorts start distributing during this phase as they realize that a steep price action is unsustainable. There is, however, a good chance that some major long-term support or resistance has been met in that currency and the short-term or medium-term trend could reverse. We therefore also need to look at reversal patterns along with continuation patterns to help us decide whether we need to go along with the trend or to trade against it. When attempting to identify continuation or reversal patterns, we need to study the price formation, the type of pattern, the measuring implications, and other considerations that we will look at. Since we are in the beginning phases of technical analysis and we are looking to identify primary, secondary, and minor trends and trade in the direction of the trend, we first look at continuation patterns. These patterns are usually short in nature as the market has merely paused before continuing the original trend, as opposed to reversal patterns. So reversal patterns take much more time to form since it requires a greater force to change the direction of something that's already in motion rather than to slow it down and resume its direction.